Hey guys, welcome to Learning Accounting. I'm Jim Abdulkabir, the founder of Learning Accounting, and this particular channel is expected to treat all related accounting issues, especially for professional accountants. So we'll be looking at courses like financial reporting, corporate reporting, or strategic business reporting for all type of exams, be it the ACCA exams or the ICANN exams or other related tertiary education exams like the masters, the postgraduate or the undergraduate issues, all those exams, we'll be looking into them. Now I would like you to watch the video and drop any questions in the comment section, and I'll be here to answer your question for you. So stay tuned and watch the video to the end. Hey guys, welcome back to Learning Accounting, and today we want to look at a question on IAS19 Employee Benefit, because this is another interesting area for IAS standards, and a lot of students I think would prefer this type of standard in an exam situation because they are not too difficult to handle. But notwithstanding, let's look at this particular question I have for us and to guide us on how to answer this style of questions whenever they come to light in any exam you find yourself in the future. Okay, so let's take a step at it. So here we have brain operates. Okay, quickly, I usually prefer to read the requirement paragraph first, which is like the most important thing. So the name of the question is brain. I actually give it that name. And the question says we should prepare an extract from the notes to brain's financial statement for the year ended 31st December 2001, which shows how the pension should be accounted for. Okay, so here they say brain operated defined benefit plan. Okay, defined benefit pension plan. Now bear in mind these sessions are just for answering questions, and I might not be going details in some of the standard. Yeah, I know, but you could always make your comment. I can go ahead to give you details, or you could subscribe for like a paid version where definitely I can give you a whole lot of details about the standards. Okay, now back to the question. The PV of the future benefit obligation and the fair value of its plan assets at the beginning of the year, which is 1st of January 2001. Remember, the year end is 31st December 2002. Okay, it's 120 million and 160 million respectively. So when it comes to the defined benefit plan, of course, in respect to defined benefit plan, we have the assets books and the liability books. The asset books or the liability books, we have it as a PV of the lease, sorry, not lease, rather, PV of future obligations, or PV of plan obligation. Let me use that word, plan obligation, while we have fair value of plan assets. Now the question has given us the actuarial value at the beginning of the year. Okay, this is not a T account, bear in mind. I'm only just putting them by side to make it easy while picking out the information in the question. So we have here for obligations, we have it to be 120, and for assets, we have it to be 160. So we have it here, 120 for obligations and 160 for assets. Again, this is the actuarial figure at the beginning of the year. Okay, so let's go back to the information in the question. It went on to say that the pension plan received contribution of 9 million. Now, of course, what they mean by the received contribution is that it was paid that period to the scheme, meaning we are increasing the scheme, the plan assets. This is actually a cash flow transaction, and they said paid pension to former employees of 15 million during the year. So actually created a format, and I'm going to actually apply it in line with the format I've created. So here I'm going to leave a space and I'll call this interest. Similarly, I'm going to have interest here as well. Then I'm going to have contribution to the scheme, and contribution to the scheme according to the question is 9 million. So I have 9 million because, like I said, this is a cash flow transaction. It's a debit item here, and the corresponding entry we're actually crediting cash. That's what makes it a cash flow transaction. Don't forget, this is also a debit item and this is a credit item in terms of liability. Okay, so you'll be seeing the implications of the debit and credit, but we're using it to create the format. Now back to it. It also said it paid 50 million to the former employees. Now what is paid is benefit paid, and benefit paid affect both plan assets and plan obligations, because we're using the assets to settle the obligations. Therefore, we are debiting our obligations and we are crediting our plan assets. Okay, but before then, let's read further a little. I'm going to make use of that information, but I want to manage my space. Extract from the most recent actual report shows the following. The PV at the year end, again, was given for both plan assets and plan obligations. We had the both 126 and 160 respectively again. Okay, and then they said the present cost of pension earned in the period, which is more like the current service cost in the period. So you have that word current service cost. And the current service cost in the period, according to the question, is 16 million. We have it here, 16. Of course, we are crediting this account. And we're debiting the profit or loss because it becomes a profit or loss item at that date. Moving forward, he also went on to say that yield on high quality corporate bond at the beginning of the year is 15 million. Now, one of the clues is that always pay attention to the interest rates, because the interest rate at the beginning of the year is what you're using, because it's increasing the obligations at the beginning of the year or increasing your assets at the beginning of the year. But in the event they give you both rates, like rate at the beginning of the year and rate at the end of the year, you always use the rate at the beginning of the year. Okay. It then said on 1st of January 2001, I was a mistake on my part, it's supposed to be 2001, not 2011. The rule of the pensions plan were changed to improve the benefits for plan members. The actuary has advised that this will cost 20 million. So there was an improvement in the pension plan. And whenever there's an improvement in the pension plan, it gives rise to what we call past service cost. Now, past service cost is an additional expense to us, so it increases our obligations. So we have past service cost 20, like I said, it's an additional expense. It's increasing our obligation. We are crediting the account. But this past service cost will form the computation of our interest because it's happening at the beginning of the year. Therefore, we have 120 plus 20, of course, which gives us 140 multiplied by the interest rate at that date, which is 15%. So we have it to be multiplied by 15%. Okay, let me just pick up my calculator here. And we have 140 times 15%, and that gives us 21. So we have this to be 21. Again, this is a credit here because it's increasing obligation. The
corresponding entry makes it a debit entry in the profit or loss. So these are actually non-cash items, as you could see them. We're going to do the same calculation here. We have 160 times 15%, and 160 times 15% again. Let me get my calculator. 160 times 15%, that gives us 24. So we have 24 here, and 24 here is a debit item because it's increasing our planned asset. Corresponding entry goes to the profit or loss as well. Okay, then we have benefit paid. And benefit paid, according to the question that we just read, benefit paid is 15 million here. So we don't forget that information. 15 million is deducted here, and we also have benefit paid of 15 million. We are also deducting, and like I've mentioned, we are debiting this account and we are crediting this account. So we are eliminating both sides. Now at this date, we have a value in our books. So we can use our calculator. 120 plus 21 plus 16 plus 20 minus 15. So what we have in our books today is 162. Do the same thing for assets. We have 160 plus 24 plus 9 minus 15, and that gives us 178. So this is what we have in our books as of today. But remember, we are also going to look for the actuarial figure. So the actuarial comes to give us a figure also at the year end. We have the balance CD and the balance CD. So what is the figure at the year end? Is given there in the question. We have 126 and 160 respectively. $126 and $160 respectively. Now this gives us a remeasurement, in this case gain, because liability is reducing. We have 162 minus 126, 36. So liability is reducing by 36. It makes it a what? A remeasurement gain. On the other hand too, we have a remeasurement gain here as well. So a remeasurement loss. And why it's a remeasurement loss? 17. Because asset is also reducing. So asset is reducing is a loss, liability is reducing is a gain. Liability increasing is a gain. Of course, asset is increasing is a gain. So you understand it that way. So going to the profit or loss extract, if you have to show it, profit or loss extract, we're going to have interest income. Interest income 24, we calculated that to be 24. We have interest expense to be 21, the expense item. We have current service cost 16 and past service cost 20. Current service cost 16 and the past service cost 20. Profit or loss item. Other comprehensive income, we have remeasurement gain or loss. Because for assets, we have a loss of 17 or 18, you can be sure. 18, not 17. So we have a loss of 18, and liability, of course, we have a gain of 36. Now bear in mind is the net gain that will go, but I'm only just giving the breakdown of those informations. And similarly here, you could just call it pension costs. Since the expenses are more than the assets, are more than the income. Same thing here, you can call it net pension gain, net remeasurement gain, as the case may be. Statement of financial position. We have the opening balances and the closing balance for assets. And funny enough, assets we have 160 at the beginning and 160 at the end. The figure is actually the same. I could see 160 at the beginning and 160 at the end. But for liability, we have 120 at the beginning, but now 126 at the end. So we have liability 120 at the beginning and 126 at the end. And this will give us a net asset. So this will be 40 and this will be 34 respectively. Okay, so this is how to account for employee benefits when you have a defined benefit plan or defined benefit plan scheme. So for defined benefit plan, of course, you have the asset side and the liability side, and you consider most of these things. So everything I've done here, like I've showed you, is just a double entry, but we are summing it up. Of course, we could also match these information together and just have net obligations or net assets, as the case may be, depending on how you've learned it before. And this, I'm sure it's not far from what you know, and it will only help you to understand it much better. So ladies and gentlemen, I believe this short video must have helped you to understand IAS19 employee benefits when we talk about defined benefit scheme.
Now that you're done watching the video, I'm sure it was insightful and it was educational. Make sure you subscribe on our YouTube channel and like our videos, and also share these videos with other friends who might likely have the same exam as you. And I'm sure we'll be seeing again in another session. This is Learning Accounting.